Most people track the wrong numbers when they think about wealth. They focus on income, account balances, or net worth, but those don't tell you if you're actually prepared to build and keep wealth. There are 3 quieter numbers that reveal far more about your financial readiness, and most people never look at them. In this video, we're breaking down the 3 numbers that show whether you're truly wealth ready, and why getting them right changes everything that comes after. Before we get started, if you want to measure financial progress the way wealth actually works, hit subscribe. This is where money clarity begins. Your savings rate. The first number you need to know is your savings rate. This isn't just about how much money you have in the bank. It's about the percentage of your income that you're actively putting away every single month. Here's the reality check. If you're saving less than 20% of your take-home pay, you're not wealth ready yet. You're living paycheck to paycheck with a nicer bank balance. Wealth-ready people aim for at least 20 to 30%, and the truly serious ones push it even higher. Why does this matter so much? Because your savings rate is the foundation of everything else. It shows discipline, it shows you can delay gratification, and it proves you're thinking beyond today. Calculate your savings rate right now. Take your monthly savings and divide it by your monthly income after taxes. If that number is below 20%, you've got work to do. Cut the subscriptions you don't use, skip the impulse purchases, and get serious about your financial future. Remember, building wealth isn't about how much you make, it's about how much you keep and grow. A high earner who saves 5% is worse off than a modest earner who saves 30%. Your savings rate is your commitment to future freedom. Think about it this way. Someone making $50,000 a year who saves 30% has $15,000 going toward their future. Someone making $100,000 who saves 10% only has $10,000. The person making less is actually building wealth faster. That's the power of a high savings rate. And here's another truth. Your savings rate directly determines how fast you can reach financial independence. If you save 10%, you'll need to work 9 times as long as if you save 50%. That's not a typo. The math is clear. Higher savings rate equals faster freedom. So stop making excuses about not earning enough. Start tracking every dollar and find ways to increase what you're putting away. Automate your savings so it happens before you even see the money. Treat your savings like a bill you have to pay, because it's a bill to your future self. Your debt-to-income ratio. The second number is your debt-to-income ratio. This one's a brutal truth teller. If your monthly debt payments are eating up more than 36% of your gross income, you're carrying too much debt to build real wealth. Think about it. If you're spending over a third of your income just paying off what you owe, when do you get to invest? When do you get to save? When do you get to actually grow your money? You don't. You're stuck in the hamster wheel. Here's how to calculate it. Add up all your monthly debt payments, including credit cards, car loans, student loans, and your mortgage. Then divide that by your gross monthly income. If you're over 36%, you need to attack that debt like your future depends on it, because it does. The ideal debt-to-income ratio for someone who's truly wealth-ready is under 20%, or even better, 0% on everything except maybe a mortgage. High debt isn't just a number on paper. It's a weight on your shoulders, it's stress in your mind, and it's a barrier between you and financial freedom. Pay down that debt aggressively. Use the avalanche method and knock out the highest interest rates first. Or use the snowball method and get quick wins by paying off the smallest balances. Either way, make debt elimination a priority. Every dollar you free up from debt payments is a dollar you can invest in your future. Let me give you a real example. If you're paying $500 a month in credit card interest, that's $6,000 a year that's just disappearing. Over 10 years, that's $60,000. Now imagine if that money was invested instead. With compound interest, it could grow to over $100,000. That's the true cost of debt. It's not just what you're paying now. It's what you're losing in future wealth. And here's something most people don't realize. Debt doesn't just cost you money. It costs you opportunities. When you're debt-free, you can take risks. You can start that business, switch careers, or invest in yourself. But when you're drowning in debt, you're trapped. You can't leave that job you hate because you need the paycheck to cover those minimum payments. That's not freedom. That's financial prison. your emergency fund in months. The third number is your emergency fund measured in months of expenses. This is the number that proves you can handle life when it throws curveballs. And trust me, life will throw curveballs. Here's the standard. Wealth-ready people have at least 3 to 6 months of living expenses saved in an easily accessible account. Not invested in stocks, not tied up in retirement accounts, but liquid cash they can grab in an emergency. Why is this so critical? Because without an emergency fund, the first time something goes wrong, a car breaks down, a medical bill hits, or you lose your job, you're right back into debt. All that progress you made gets wiped out in an instant. Calculate this number by adding up all your essential monthly expenses like rent, food, utilities, insurance, and minimum debt payments. Then multiply that by the number of months your savings would cover. If you're under 3 months, you're not wealth ready. You're one emergency away from a financial disaster. Start building that emergency fund today. Even if it's just $50 a week, get that safety net in place. Once you've hit 3 months, aim for 6. And if you're self-employed or work in an unstable industry, push for 9 to 12 months. This fund isn't about being paranoid. It's about being prepared. It's about having the peace of mind to take smart risks and make bold moves because you know you've got a cushion to fall back on. Wealth-ready people don't wing it. They plan, they prepare, and they protect themselves. Here's what most people get wrong about emergency funds. They think it's wasted money just sitting there doing nothing. But that's completely backwards. Your emergency fund is working for you every single day by giving you freedom from fear. It's the difference between having to take the first job offer that comes along versus being able to wait for the right opportunity. It's the difference between staying in a toxic work environment because you need the money versus having the power to walk away. And let me tell you something else. Having an emergency fund changes how you make decisions. When you know you're protected, you think differently. You invest more confidently. You negotiate harder. You take calculated risks that can actually pay off. People without emergency funds make desperate decisions. They cash out retirement accounts and pay penalties. They take out high-interest loans. They accept whatever life throws at them because they have no other choice. Don't be that person. Being wealth-ready isn't about having more. It's about being prepared. These numbers tell you whether your finances can handle opportunity when it shows up. Once you know them, you stop guessing and start building with intention. If this gave you a new way to think about your money, like subscribe and share it with someone who's serious about doing things right.